All right. Well, good afternoon and welcome to the end of day market review for May 16th, 2012. My name is Jason Waugh, one of the trainers and success coaches with Ideal Trading Lifestyle. I'll be walking us through today's presentation. Now, before we go ahead and get started, we are going to ask that you give this disclaimer a quick read. Once we're done, we're going to go ahead and get started with the rest of the presentation. All right, and I am going to apologize if I don't end up muting my line quick enough. I am fighting the wonderful allergies that go along with this summer weather, so please bear with. Now we're going to go ahead and get things started by taking a look at the market news, the number one contributing factor to the overall market conditions. As we can see, there really isn't anything new going on a global scale. We're continuing to look over to Europe and seeing the concerns that they're having and seeing how that it's ultimately affecting the rest of the US markets. We can see that the markets all ended up down, with the Dow Jones down 0.26% and the S&P 500 down 0.44%. Oil is also declining. It is down 1.33% to $92.73 per barrel. Gold is also on its decline, down 1.07%, down to 15.40 and 50 cents per ounce. So we can see that both the commodities and the US markets are continuing their decline. In fact, we've seen red right across the board for the entire duration of this week thus far. We're now going to go ahead and take a look at the market sentiment. This will include analysis on the S&P 500, where we'll be looking for support and resistance levels. We'll also be identifying the the S&P 500's MACD. We're then going to switch over and take a look at the volatility indicator. All right, so looking at the trend lines and the cycle lows that have been established throughout the recent recovery that dated back in December and worked itself up to April, we can see that the declines that we've had for the duration of April and May have pushed themselves down below significant levels of support, where we're now looking to find support at around 1310, which is the uh, insignificant cycle low that was established back in the latter portion of January. Whether or not we'll find support here, though, is going to be really dependent on where things are going with Europe. Currently, we're looking at a MACD, which is declining bearish, with the black line down below the blue line. Because of this, we know that support levels don't necessarily hold up as well as they should, especially when we're looking at a bullish market condition. So right now, we can hope that we'll find support there, but we're not going to be expecting that. We certainly won't be getting into any positions assuming that the markets are going to be flattening out and then recovering. We need to make sure that we establish support, actually physically be able to draw some trend lines and see the markets start to work themselves back up. All right, now here we are looking at the volatility indicator. As we can see that it's still trading above 20. This is the third day now where we've seen the indicator up above 20. It's currently sitting at 22.31. What this means for us is we see that the volatility is increasing. We see that traders are concerned and traders are really starting to get prepared for what might end up looking like a downward cycle on a more global scale. And what I'll end up doing is I'll actually go to some of our charts and I'll explain this a little bit more. But with the volatility indicator increasing, we can expect to see larger losses and more sporadic trading where there really isn't any rhyme or reason to what's going on. People are going to be focusing exclusively on opening news and futures and making their trading decisions based on anything that might come out on an intraday basis. There won't be any significant runs where we can get into positions for long periods of time. Rather, we need to make sure that we hold back and really take a cautious approach to our trading. We can do this as easily as reducing our position sizes, just making sure that we're buying fewer stocks, and for our advanced customers, lowering your profit targets and tightening up your stop losses to logical locations. Combining these two, we will be able to survive the market conditions, especially for our basic customers who are relying on our watch list to help them with their trading decisions. There is nothing on our watch list today. There hasn't been anything on this watch list for the last several days. And this has been done to safeguard ourselves from the major declines that we've been seeing. In fact, for the month of May, the S&P 500 is already down a little over 6%. So we can see that the watch list has been empty. It might look uneventful and boring, but it saved us from a national average of 6%. So with that said, I don't normally like to get into looking at our advanced charts where we've got some of our more advanced indicators such as our stochastics RSI as well as daily EMAs. But there is one thing that I think even our basic customer can learn from this, and that is that we use the MACD to identify bullish, bearish trading tendencies, and this is good. It certainly helps us on a momentum trader's point of view, and helps us identify the ideal time to be trading more aggressively or more casually. But there's a large portion of the market which rely on the 200 EMA. And that 200 EMA is this black line right here. Now, I'm not going to get into the full spectrum about how an EMA is calculated or what it does, but for the purpose of this, we're looking at a 200 daily EMA. This means we're looking at 200 days worth of data. We're taking the average closing price of all of those days and dividing it by 200. Now, it's going to be putting a little bit more emphasis on the most recent weeks as opposed to the weeks near the beginning of those 200 days. So it's not going to be a perfect math unless you have the formulas that go along for the exponential moving averages. But for the purpose of this, you've got an average of 200 days, and it looks like that 200-day average is somewhere in the vicinity of 1,316. Now, why is this important? This is important because a lot of investors out there use this to identify bullish or bearish. And although we've been bearish since what do we have here, 4th of May, a lot of investors still believe that we're bullish. And a lot of investors are looking to find some key support levels at this 200 EMA. Now, this very well might end up happening, but we can't say for certain. We don't know what's going to go on in Europe. We don't know what's going to happen with the rest of our job loss reports or commodities. There's just too many things to be able to predict this. But there are a lot of individuals that are holding on to this 200 EMA. If we see a decline down below this 200 EMA, we're going to have a lot of other people now saying that the markets are bearish. And that's when you're going to start to see a little bit more concern in the news. Just chatting with Randy, him and I were going through and analyzing the markets, and we acknowledged that we really haven't seen a lot of doom and gloom or concern coming from the news about the market conditions. Yeah, we are looking at the declines, but nothing that says that we're in a major decline as of yet. If we even go back to a 1-year chart, you're going to see back here in 2011, just at the beginning of August, we ended up crossing down below this 200 EMA, and we can see the substantial loss that was a result of that. Are we going to end up with that same loss? I don't know. What we do know is that 200 EMA is substantial. It very well could hover around there for a little bit, but if we see anything closing below that 200 EMA, we might end up in these same types of market conditions for another couple weeks even. We really have to be careful with that. So I know I'm preaching to the choir. I know everybody's all very well aware of the market conditions and very well aware that the markets are declining. We're going to continue to sit on the sidelines. We're going to continue to see what ends up happening. And as the markets start to fix themselves, wherever they end up finding support, that's when we're going to take advantage of getting back into some of our positions. Basic customers, that might be a little bit of a wait. Advanced customers, keep a close eye on your charts. Make sure that you can truly identify support before getting into any positions. And for our ideal trading lifestyle customers, wait to see a stock show up on our watch list and continue to watch the position size and calculator for any updates there. So this has been the end of the presentation. Does anybody have any questions? All right, good. Yeah, perfect. All right, guys. Well, as usual, thank you for attending today's presentation for Wednesday, May 16th, 2012. Have a great day.